So basically today, what we're going to do is we're going to continue on with the last topic of our course. And we really have just one objective with today's lecture, which is to talk through and do a few examples related to something that is referred to in practice as waterfall analysis. Now, what is waterfall analysis? Now, we've talked about VC securities so far, correct? And I introduced the three common types of VC securities that are used. And I showed you what the financial implication of those securities were as a payoff diagram, correct? Where it would be like, how much does the owner of that security get in the y-axis, and then the x-axis was what is the exit value of the company. Now, the payoff diagrams that we drew out were only correct if that is the only security aside from common equity that the startup has issued. In other words, it's only true if the startup has had one single round of investment. Now, as we discussed in topic one, when we talked about the life cycle of funding, or the funding life cycle, we know that startups actually get multiple rounds of funding, correct? Now, it turns out those payoff diagrams change when you have multiple rounds of funding. And there's a process to figuring out how they change. And some people find it elaborate. It turns out it's kind of algorithmic, right? But it requires a real discussion. And we'll have that real discussion today. Sound good? Look, I'm going to start sharing my slides. Share screen. Can folks see my slides? Perfect. I'm just showing, to illustrate my point, just showing you the funding life cycle of two startups. One you may have heard of, Facebook. If not, I don't know where you've been for an extended part of your life. Well, we can see many rounds of funding. Seed, Series A, Series B, multiple doses of Series C. There was actually a debt round. Debt here means venture debt, so it's not really like debt, okay? It converts into equity eventually if things are going well. Series D, private equity. I'm actually not sure what that was, to be honest. But we can see multiple rounds of funding. So assuming a single round of funding for Facebook seems like a pretty bad cartoon. So, right? Even companies that we haven't heard of and that eventually fail, can raise multiple rounds of funding. A fab was like an online marketplace in design maybe for, I don't remember the full details. I just remember that it ended up selling itself for $15 million after raising $336 million. So that's why I said it eventually failed. But it actually was a unicorn at some point, right? So it is possible for a unicorn to go down to approximately zero, where every single employee in the company and every single founder in the company ends up with a big fat zero. It happens. Fab is an instance of that. But my point with this slide is, we want to be comfortable with multiple rounds of funding, because guess what? There can be hella multiple rounds of funding. Uber had like 18 rounds of funding. 18. They almost ran out of the alphabet. Look, the process of analyzing look, let's be clear. This is what we call a complex capital structure, right? Because it's not just debt and equity. There's a lot of different stuff here. That's why I said, probably in the first lecture of the semester, that actually startups have some of the most complex capital structures in the world. It's because they have so many different types of preferred equity on their cap table. And analyzing it is complex. Before we analyze it in a complex way, let's analyze it in a simple way that doesn't tell the whole story, but it's still useful to do the exercise. Folks okay with that? So this is what we call the capitalization table, also referred to by practitioners as the cap table. What does this table do? It lists all parties with stakes in the startups and calculates the number of shares owned and percentage ownership for each stakeholder on an as converted basis. That means, because remember, all preferred shares, there's the option to convert it, correct? So a cap table just says, hey, if everyone for some odd reason just decides to convert so that there's no more preference left, everyone just is with their common shares, how much does everyone own of the pie? That's what a cap table usually tells you, right? It doesn't tell the full story because it ignores downside protection, right? Because if you don't convert, you're taking your downside protection. Are we okay with this? Right? So, right, and just a clarification, when I say as converted basis, I say assuming that preferred, any type of preferred equity, that is, converts to common, and that employees exercise their employee stock options, for instance, yada, yada. So let's actually look at a cap table, and we'll appreciate just how easy this calculation is. So we'll assume the following capital structure. Founders own 40 million shares of common stock. So far, so good? Series A, the first round of investor, owns 10 million shares of convertible preferred stock with a liquidation preference multiple of 1, convertible 1-to-1 into common. So you can take these 10 million preferred share, bring them in and say, give me 10 million common share. So far, so good? No dividends, whatever. Series B owns 5 million shares of convertible preferred, also with a liquidation multiple of 1, convertible 1-to-1, no dividends. So they can convert to 5 million common shares. Series A and B have liquidation preference that are pari passu. That means equal seniority. I will get to that later. It's not relevant in the cap table. And then finally, employees own 25 million stock options on common stock. I'm not specifying the strike price just because I don't need to for the cap table. Are we okay with this so far? So cap table here is easy. By the way, some people include employees in the cap table. Some people only include employee shares that are already owned in the cap table, so they don't include the options. Some people don't include any of the employee stuff in the cap table. Okay, so different people mean different things when they say a cap table. Okay? I'm including everything, including the employee options, okay? So cap table is what? Founders, on an as converted basis, how many shares are there in the company? Founders have 40 million. Series A has 10 million. Series B has 5 million. And employees have their 25 million shares because as converted means they exercise their stock options. Are we okay with that statement? So add all this up, that's 80 million shares. So cap table just says, well, 40 divided by 80 is 50%. 10 divided by 80 is 12.5%. 5 divided by 80 is 6.25%. 25 divided by 80 is 31.25%. That's the cap table. It's just a simple cartoon representation of a complicated capital structure. We okay with this so far? Look, notice I didn't tell you guys in the Series A and Series B, like how many people participated in each round and whether there were VCs that participated in both the A and the B round. Like in the real world, all of those things can happen. Usually VCs don't invest solo, right? They often invest in syndicates in modern times, meaning that there's maybe 2 VCs that have a bit of the deal. In a Series A, you're more often to see just one VC, but a Series B, it's pretty rare that it's just taken by one VC, right? So sometimes instead of doing the cap table by round, Series A, Series B, sometimes people bunch it by VC. They're like the VC, like Sequoia took all of round A and took half of round B. Then the cap table would say Sequoia, and it would say they own 12.5 million shares, right? All the 10 million and 2.5 of the 5. And then the fund that invested, the other venture firm that invested with them in the B round, let's say it was Excel. Excel owns 2.5 million shares. Okay, so people kind of organize it in different ways, right? But the thing that matters is that you realize every number here is on an as converted basis. Are we okay with that? Okay, this is the easy part, okay? Now we go to the real thing. Instead of a cartoon like this is like a cartoon that's drawn by my 4-year-old son. It doesn't tell the whole story. I love him to bits, but it doesn't tell the whole story, right? Now we want something that tells a fuller story. Now, it's not like photorealistic, but it's like, you know, a cartoon drawn by someone who has actual experience and skill drawing cartoons. I don't know who that person is. Bart Simpson's creator or something like that, right? That's what we're doing next. So it doesn't tell absolutely everything, but it tells you a lot more. Maybe Simpsons was a bad example for that because that's not a super pristine cartooning either, but yeah, anyway.
Jiro?
Yep.
Just a really quick question on what you were saying before. So like to go back to your example of, let's say Sequoia takes all of round A and half of round B, and a sell comes in for the second half of round B. Mm-hmm. When those funds are being raised, is it completely confidential who's committing at that fund, or do you get to know?
You mean at the fund? Sorry, at the fund or at the startup level? The
startup level. What I'm saying is when funds are committing to give capital to startups, does Sequoia know that a sell is also jumping in and vice versa, or no?
Oh yeah, no, they know. They're teaming up to get they're like, yeah, this is a conversation. People aren't like secretly like, oh, the person that was with you, let's do the reveal. It is 2 AirPods. No. It's you don't want to do that. Like you want to get a feel like, do these people work well together? Are they actually maybe too close to being friends so they can gang up on me? Like this stuff, it's not, I mean, has there ever been an instance when there's been a bit of secrecy in the whole thing? I'm sure, right? You've got some paranoid people in the world. I might be part of that set. I'm not sure, but like, look, there's no doubt, like, every instance where I've known people raising funds, they're being transparent and like making sure, like, does this VC fund even want to, like, are they even still interested if we propose a syndicate of those two? Right? It's not like, no, these things, it's kind of a process and it kind of crystallizes into something where everyone's happy with it. Yeah. Anyway, I think that answers the question. Or maybe your screen is frozen. Is that what's happened? Okay.
I think I froze.
Yes.
I heard what you said though.
Okay. Like, you're not moving, man. Okay. All right.
I got your answer though. Thank you.
Okay, perfect. All right. So now we start doing the slightly more elaborate cartoon. It's no longer a cartoon. It's a painting. It's Van Gogh. It's pretty good. It's just not like a picture. Okay. So how do we do it? I'm actually doing the example that I just described would actually be too complex an example to start with, right? So I'm going to simplify it by just dropping out the employee options in the example I'm about to do. Folks, okay with that? So this is what we're going to be calling a 2-round waterfall, because there's 2 stakeholders aside from founders. Are we okay so far? And we're going to walk through the process because it is literally a process. It's an algorithm for solving this problem. Okay? So let me describe it. Right? So consider the cap table example just covered, but assume that no employees own options. That's just for me to make this an easy intro waterfall analysis. Problem. What are the payoff diagrams for Series A and Series B? What's the payoff diagram for the remaining common shares? Do we agree that those are the three stakeholders in the company? No other stakeholders is what we're assuming. And we'll assume that Series A and B were purchased at $1 per share and $4 per share, respectively. In other words, how many shares in Series A? There were 10 million, correct? So if they were bought for $1 each, that means there was a $10 million investment. Do we agree with that? And so if the liquidation preference multiple is 1, what is the liquidation preference in dollar terms? 10 million times 1, i.e. $10 million in liquidation preference. So far, so good? I'm giving you this information because you need it to be able to solve this problem, right? Same thing, $4 per share in the Series B. There were how many shares? 5 million. So that means $20 million was invested in the Series B, correct? So liquidation preference multiple of 1 again. That means the liquidation preference total in dollar terms for Series B is 20 million. So now we have the basics of this problem. How do we do our waterfall analysis? There's a solution procedure to it, which is the first thing we need to figure out is, look, Series A and Series B, they're not forced to convert at the same exit levels. They kind of independently choose what their conversion is, correct? So we want to find out which of the two VCs, Series A or Series B, converts first. When I say first, I'm putting this in quotation marks. First doesn't mean first in time. It means who converts at a lower exit value, right? Because maybe Series A converts starting at an exit value of 100 million, while Series B converts starting at an exit value of 200 million. That means between 100 and 200 million, only Series A converts. And once we reach 200 million, both of them convert. Do we agree with that statement? So we need to find out, both parties are rational. They convert when they make more money from converting. So who goes first? Again, first in quotation marks. So we're going to have to answer that question in step 1. And then once we find out who converts first, then we can ask, well, who converts second or last in this case? And at what exit value do they convert? Are we okay with this? And then once we've found out the conversion points for both stakeholders, then we can use logic to map out what each payoff diagram looks like. By the way, I just described the process for two stakeholders above the common equity. So actually 3 stakeholders. If you have n rounds of funding, your process is now see who converts first, see who converts second, see who converts third, and then see who converts nth. And then you logically tie it all up together to get your full payoff diagram. So the algorithm I have here can be generalized. Folks okay with this? By the way, on my courses, I have PDF files, handwritten, that give you guys extra waterfall analysis examples. One of them, it's called VC Fall 20 Topic 4P1 Waterfall Analysis Examples. This is waterfall analysis examples on the first page. It's 9 pages long. It says here, general procedure for determining these payoff diagrams. So I actually describe the process here more generally. I'm not going to describe it in the lecture notes, in the slides, but it's described here. So you guys can read that on your own time. I mean, you'll kind of have a feel for it after we've done all our examples anyway. Sound good? This is one of these things where you don't, most people don't learn the algorithm, then start applying it. They get a feel for the problems, and then the algorithm just kind of naturally emerges in there. you know, in their mind, or I don't know what the word for it is. Osmosis. I don't even know. I shouldn't even say words that I don't know. Okay. So, so let's go ahead and use this algorithm in the context of the example we just discussed. So who converts first? What we're going to do is we're going to do two hypothetical calculations. We're going to ask ourselves, if A converts first, at what threshold exit value do they convert? And then we will flip side ask, well, if instead B converts first, at what exit value would they convert? Out of the two, the one that gives us a smaller number is the one that actually goes first. Does that make sense to you guys? So let's go ahead and figure this out. So this is important calculations to follow. Slow me down if needed. So if A converts first, what we want to find out is, what does A get? We know that if A does not convert, they get 10 because that's their liquidation preference, correct? I mean, if the company is worth less than 10, we know that they're not going to convert, because if it's worth less than 10, they get the whole thing. Right? So, okay, caveat, they're splitting things with the Series B. So I'm being a little bit sloppy with my wording here, but where I'm not being sloppy is with this calculation. Okay, if A converts, how many shares do they own? 10 million, correct? And if they have converted, but B has not converted, we know B has not converted because A converted first. Then how many total shares is there in the company? There's the 10 million that these guys just got, correct? And then there's the 40 million that the founders own. Do we agree? If only A converts, A owns 20% of the common equity. Do we agree with that statement? Well, what does that common equity entitle them to? It entitles them to 20% of everything that's left after we've paid the liquidation preference of B, because B is not converted. So they're saying, give me my 20, because 20 is the liquidation preference of Series B, 5 million times $4 per share. Does that make sense? So this is an important equation to follow, right? If I convert, I get 20% of V minus 20, because the 20 is taken by B first, because B, still has their liquidation preference. They did not convert. So when is V big enough to justify this conversion? This is just a simple mathematical equation, right? This is 1/5. We multiply by 5 on both sides of the equation. V minus 20 greater or equal to 50. Bring the 20 to the other side. V greater or equal to 70. Make sense? So what this says is, if A converts first, A converts at an exit value of 70 million. Now let's ask the other hypothetical question. The other hypothetical question is, well, if instead B goes first, what happens when they go first? They now get 5 million shares. So they own 5 out of now 45 million shares. So they get this percentage, that's 1/9, of V minus 10. Because now A has not converted, they get the first 10, and they have a liquidation preference of 10. Make sense? And that needs to be higher than the 20 that they can just take. So 1/9, so multiply by 9 on both sides, 180. Bring the 10 to the other side, 190. So if B converts first, they convert at 190 million. So which one actually converts first? Series A or Series B? I think Mike invisibly said Series A.
I said A, yeah.
Okay, A, yes. That is correct, because they cannot be converting first at 190, because A has already converted at 70. So we know who converts first. It's A. When do they convert? At 70 million exit value. Totally logically sound. So far, so good? The next question we ask is, who goes next? Now, who goes next is the same thing as who goes last in this particular example. But if we had, let's say we had 3 rounds of funding, then we would ask, what if A goes first? What if B goes first? And what if C goes first? You see what I'm saying? And then we would pick the lowest number. Let's say that was Series A. Then in the next step, we would ask, who goes second? Is it B or is it C? We would check both, take the lower number. And then the third step would now be who goes last or third. And we would check when that third one converts. Right? So you see how the number of steps you have to do goes up the more rounds you have. Make sense? By the way, it's also useful to note, the more rounds of funding you have, the number of calculations you need to do goes up fast. Because if you have 5 rounds of funding, step 1 involves 5 calculations. What if A? What if B? What if C? What if D? What if E? 5 calculations. Step 2 now has 4 calculations because you have 4 left. Step 3 has 3. Step 4 has 2. Step 5 has 1. 1 plus 2 plus 3 plus 4 plus 5, right? With 5 rounds. If you do the math, I mean, this is a simple, like this is apparently a mathematical proof that Gauss did when he was 8 years old, which is 1 plus 2 all the way up to plus n. The formula for that is n times n plus 1 divided by 2. I mean, it's logical. You can see how a very, very, very brilliant 8-year-old could do it, actually. But what this is telling you is the number of calculations you do when you have n rounds of funding is literally n times n plus 1 divided by 2 plus 1 because you have to tie it all up together in a last step. So the number of calculations goes up fast. If you've got 10 rounds of funding, we're talking about 56 calculations. So interesting to note. You can rest assured I'm not going to ask you to do a 10-round waterfall on the final exam. You know, it's basically, I'll probably ask you guys a relatively easy 2-rounder and then a slightly more elaborate 3-rounder. That's kind of what you can expect on the final. So far, so good? Okay, but now let's go back to our actual step 2 in this simple problem, where step 2 here, there's only one investor left. It's Series B. So we just need to ask the question, when does Series B convert? At what exit value? So far, so good? But notice it won't be 190 million because this assumed that A did not convert. But now we know when they're making their decision, A has already converted. Does that make sense? So what is the calculation? Well, Series B now, when they convert, they know they need to get more than 20. They get 5 million, but now there's 55 million shares because there's already the 40 million to founders and the 10 million to Series A because A already converted. So when B converts, we know there's 55 million shares. Do we agree? But once B converts, how much liquidation preference is there left in the company? 0, right? Because now everyone is converted. So notice there's no V minus anything. It's just V. Everything is equity, common equity, correct? So what? 55 divided by 55 times V greater or equal to 20. That's the same thing as V greater or equal to 220. Right? You just multiply both sides by 11. Are we okay with this? So we're pretty much ready to go and do our last step in this process, which is to take the awareness of when conversion happens to map out payoff diagrams. Can I go ahead and show you guys this now? So this is the payoff diagram for Series A. So what does Series A get? Well, from 0 to 30 million, right? How much total liquidation preference is there in the company? There's 10 million to Series A and there's 20 million to Series B, correct? So there's a total of 30 million, and it's equal seniority between A and B. So what that means is from 0 to 30, because Series A has 1/3 of the total liquidation preference, they have 10 out of the 30, correct? They get 1/3 of every dollar. And the remaining 2/3 goes to Series B. It's because it has equal seniority. The word pari passu means equal seniority. So between 0 and 30, Series A and Series B are splitting the whole company, 1/3, 2/3. Does that make sense? Now, what happens once you hit 30 million? Series A has plateaued, correct? So they stick to their liquidation preference, but they stick to their liquidation preference, but they're not converting. When do they start to convert? We determined step 1 earlier, they convert at 70, correct? So at 70, they convert and they start to get a slope. What is their slope? It's 10 divided by 50, correct? Because they own 10 million shares and founders own 40 million shares. So far, so good? By the way, you might be like, wait a second, Jiro, that looks a lot like what we saw before. But look at what happens at 220. At 220, there's all of a sudden an extra 5 million shares. So they get diluted. So now they don't own 10 out of 50, they own 10 out of 55. So their slope goes down. It's why? Because they get diluted. Because now all of a sudden Series B says, give me my extra shares, give me my shares. So that's what happens. It's very difficult to see it in this picture because I actually drew this at scale on my slides. But there's a kink right here where the slope goes from 10 over 50 down to 10 over 55. Folks okay with this? Does this make sense? This is the process, okay? So this last step is just about keeping careful track of where the thresholds happen at 70 million and at 220 million and measuring slopes from number of shares I own divided by number of total shares outstanding. Between 70 and 220, there are 50 million shares outstanding because it's only Series A that has converted. Meanwhile, above 220, both A and B have converted, hence 55 million shares. Make sense? So this is an important step to follow.
Jiro?
Yeah.
This equal seniority thing for Series A and Series B, basically as, is that, unless they were the same parties, wouldn't Series A kind of be a little bit pissed that Series B is now getting equal seniority? And
look, I mean, it's a contract. I mean, look, Series A can write in the contract saying, if you want to issue senior, preferred equity that is senior to us in the future, you need to ask our approval. It can be put in the contract. If you didn't put it in the contract, you can't complain about it. But you're right. What you're saying is this feels a little bit different from debt. Yeah, it is different from debt. It's called preferred equity. But I'll show you a little bit about the patterns about whether something is senior or junior or pari passu. Okay, I wrote it equal seniority here, but you can see a variety of different things. Although what I'll say is the case where the next round is junior to you, that happens sometimes, but it might be the least common of the 3 possibilities. That's just a fact, an empirical fact. But I'll show you a little bit of data too. Sound good? All right, so this is this round. Let me show you what the payoff diagram looks for Series B. Series B, can we agree, gets 2/3 up to 30? Right, so that means equity gets nothing. Common equity gets nothing from 0 to 30. We knew that. And do we agree? They have plateaued from 30 to 220 because they're not converting. Yes? Then what happens at 220? They now have 5 out of 55 million, and they just get that slope. This actually looks a lot like a one round convertible preferred, actually, right? And this is it. This is the payoff diagram for Series B. So the one that was more nuanced was Series A here because they're the ones that convert first. And because they convert first, they get diluted when other parties convert later on. Folks okay with this? Again, let me just reemphasize. When I say first here, I don't mean first in calendar time. I mean first in exit value level. Right? Because all of these payoff diagrams are happening at the exit date. Folks okay with this? We can also draw out the payoff diagram for equity. Oh, no, this is not equity. I'm sorry. When I said equity, I meant common equity, but I'm not doing that here. Mike, going back to your question, here I'm showing you the diagram. If instead of A and B being pari passu, B was senior to A, which actually you have an even bigger problem with, right? But you know what? That's more common than A senior to B, to be honest. But if B was senior to A, then that means the first 20 would go to B, correct? Do we agree with that statement? And then so A would get nothing from 0 to 20, and then would get every dollar from 20 to 30. And everything else would remain unchanged. And it's difficult to see, but I promise there is a kink here. It's just like the slope goes from 1/5 to 1/55. That's a small change. It's tough to see with the naked eye. Are we okay with this so far? And then, of course, in this scenario, what would B get? They would get the first 20, and then they would be flat to 220, and then they would go to 5/55 thereafter. Yeah? Oh, yeah, sorry. Yeah, so this is the Series B diagram. They get the first 20, and then they plateau until 220, and they get 5/55. And this is the corresponding Series A payoff when Series B is senior. Are we okay with this? Just a couple of things. You might wonder, because look, Mike's point is actually a totally valid one, because the first time I learned about this, I was like, what now? My reaction was exactly the same as yours, Mike. I was like, isn't it, must be rare for B to be senior to A. That that doesn't seem particularly nice to Series A. It feels like a screwing. Well, it happens. It's not really a screwing because VCs don't make their money from the liquidation. They make their money from the mega exit, right? So it's like protecting in the kind of space of irrelevance, some people would say. But this is just giving you a sense. Frequency of senior liquidation preference in Bay Area. That means the new round is senior to all older rounds. We can see 2002 to 2010, it's hovering at 50% or more for the most part. So more than half of the time, the new round is senior. It's fallen a little bit since, but we're still talking about 30% of the time. Okay. There is a sense that it is more common for the new round to be senior to the older rounds in times where there's not a lot of capital available, which kind of makes sense, right? There's not a lot of capital available. I'm the new investor. I play hardball. And one of the ways I play hardball is I say, make me senior to everyone else. Does that make sense to you? Which is why aftermath of the dot-com bubble, it's higher than you know, good times. See what I'm saying? You know, it is a little bit tough to explain that there was not a rise up during the during the financial crisis, right? So this is not a perfect story, but generally speaking, we think bargaining power is one of the things that allows new investors to get seniority. So far, so good. I'll show you another thing. This is the same diagram, but yellow is Series E and beyond, and this copper-ish color is Series B. Notice seniority is more often in the later rounds than in the earlier rounds. So that's another pattern that is viewed as being true. And you can see it's literally true almost every single quarter. Like there are very few quarters where copper is above yellow. There's a reason for this. Later rounds, is the upside in later rounds lower or higher? It's clearly much lower, right? You're not getting a 1000x return in a Series W. W might be interpretable as a joke, as a win. You ain't getting that win, okay? Because there's limited upside in the up rounds, when I say up rounds, I mean later rounds, like Series E and beyond. Investors in Series E and beyond know I'm not going to like carry the portfolio with one home run. As a result, I need to make sure I don't destroy the portfolio with shit outcomes. And so they're much more focused on the downside protection than early rounds that can fail everywhere and have invested one thing in Google and basically call themselves, you know, geniuses. Make sense? I think that's what explains this pattern. So, so Mike, to your question, you know, it is much more common in the later rounds where the investors are being more cautious and defensive. So like, you know, Jack Young, Deutsche Telekom Capital Partners, like he's much more likely to ask for seniority than like Inovia in their early stage investing. Folks okay with this? All right. So now what I want to do, remaining of the lecture, I want to just do one more example of a waterfall analysis, but one that's more complicated than the one we just did, to give you guys a sense of like the richness and the complexity in this exercise, while also giving us an opportunity to gain more comfort in the algorithm, so to speak. Sound good? So I'm going to do one example here. It's kind of at the upper echelon of complexity. And I'm going to do, it's called Extra 3-round waterfall problem, also posted, handwritten on my courses, correct? Okay. I have 2 other handwritten ones. One is the one that I already mentioned to you, waterfall analysis examples, which actually then goes and does 2 examples for you. So you can read this as an extra example for practice, okay? So this document that starts with waterfall analysis examples, page 1, total of 9 pages. I'm not covering it in class. It is a document posted on my courses that you can use for extra reference and extra learning. And then I have yet another document called employee ownership examples, where I talk about how waterfall analysis is impacted by both the presence of employees owning common equity and employees owning stock options on common equity. Again, we will not have the time to discuss this in class, but the document is there. It's written in a fairly readable manner. So you can review this as well if you want to learn about how employee ownership impacts the waterfall analysis problem. Are we okay? Now, here's another thing I will announce. The employee ownership example is not fair game for the final. Okay? So if you are time constrained, don't read this now. Feel free to read it maybe with Santa, maybe you guys hang out at Christmas, or no, it's Christmas Eve, right? I don't remember when he comes. I'll send him an email just to make sure I get it right. But like, you can read it on your own time. If you guys read it and you want to send me a question, you can do it. Okay, I will answer it if it doesn't get lost in my inbox, right? But you don't need to feel the pressure to do that, until after exams or until like the time is right. Okay, so like, maybe you're about to interview with a VC and they give you a waterfall analysis and there's actually employee stuff in there. Actually, a lot of times when VCs give that in an interview, they actually won't even put it because it doesn't get covered in a normal VC course. But if you ever have to deal with it, you can read this and you can send me questions if you have some. But again, that's what I'll say. Let me put it this way. All of the existing VC textbooks on the market, which I don't like any of them, to be honest, but none of them do this in their textbook, just so you know. Okay. But it is something that happens in the real world. I mean, we all know employees get paid with equity or stock options. That's an important part of comp for a startup employee. So ignoring it seems a little bit silly, right? So this gives you the material to be able to not ignore it. We just don't have the time to cover it this semester. It is what it is. It's okay. All right. But the document does explain it relatively systematically. Sound good? All right. So now we'll just focus, right? This one, I would say read it in your preparation for the final. It's giving you 2 extra examples that are fair game. It's not introducing anything new. It's just doing more examples, right? The reason why this is not fair game, the options one, is because, the employee ownership one, the reason that's not fair game is it introduces one new thing. And I don't have the time to introduce that one new thing. That's the only reason it's not testable. Okay? So now let's go to our extra waterfall analysis exercise, which is a 3-round waterfall. So we will have a Series A, Series B, and Series C. Folks okay with this? By the way, I'm putting some bells and whistles into this to make it more complex. In particular, Series A is still convertible preferred like before. However, Series B now is convertible preferred, but with mandatory conversion at 200 million exit. That's an extra complication. And Series C is participating convertible preferred with a cap. So by the way, this is like a difficult example. This is one that people have to wrap their minds around usually, even if they have experience. So I can also promise you on the final, I won't give you one that's that complex. Okay, that would be a bit mean. But I'm giving it so that you guys have a sense of the upper bound of complexity. It's a strict upper bound because I'll never go that far. Okay, so far so good? Let's go ahead and do this. So founders of 40 million shares of common equity. Series A is convertible preferred, 10 million convert 1-to-1. Purchased at $1 per share, liquidation preference multiple equal to 1. This looks the same as my example so far, my last example. It changes a little bit with convertible preferred because it's still 5 million shares, $4 per share, liquidation preference multiple of 1, no dividends, but I just added one extra thing, mandatory conversion at 200. So far, so good? And now we have a Series C. By the way, Series A and Series B, are equal seniority, but they're going to be junior to C. Meanwhile, C, of course, the flip side means it's senior to A and B. So far, so good? So our C round, 5 million shares, also convertible 1-to-1, purchased at $10 per share. So it was a $50 million investment, correct? Liquidation preference multiple of 1. So liquidation preference total here is 50 million. A cap on participation. So notice here, you won't need to convert once you hit your liquidation preference multiple because you get the benefit of participation without converting, right? But there's a cap. You're capped at 3 times your original preference. So the moment you make 150 million, which is 3 times the 50 million. The moment you're making 150 million, you plateau until you choose to convert. Are we okay here? And no dividends again. So again, this is one I won't be surprised. If you are watching this on a video or if you're watching it live for the first time, just trust me, like you shouldn't feel bad if you need to watch this example 2 or 3 times. Like there's no shame in that because this is complex, okay? So with that in mind, let's go ahead and do it. Now, how are we going to solve? It's the same algorithm as before. We figure out who goes first, right? Now, there's a little bit of a complexity thing happening here, which is if A goes first, we need to consider 2 scenarios where A goes first. When A goes first, C is still uncapped. And when A goes first, C is already capped. Those are 2 different logical scenarios where A goes first. So we have to entertain both scenarios. Same thing. If B goes first, does B go first when C is uncapped? Or does C goes first when C is already capped? Those things make a difference on when B goes. So we need to consider those 4 things. And then we also need to consider the possibility that just C goes first, full stop. So actually, even though there's 3 rounds of funding, the introduction of a cap on C actually makes us need to check 5 scenarios. Which, by the way, that little formula that I gave with my little story about 8-year-old Gauss, well, this is a counterexample to Gauss because I said n, and well, this was actually n, but we're more than n because we have 3, but we have to check 5 scenarios. So take that 8-year-old Gauss who was born 350 years before VC was invented. What do you know? I'm just kidding. I love Gauss. So in any case, let's go through our 4 cases, and then we'll do the 5th case of Series C goes first, last. So far, so good? So let's consider the case where A goes first and C is uncapped when A converts. Well, what happens there? A is converted, they get 10 million shares, correct? Founders of 40 million shares. Series A has their 10 million. The 10 million here shows up here. So far, so good? This is the one that you need to pay attention to. There's also the 5 million shares that go to Series C because they have not hit their cap yet. Right? Remember, if you have not hit your cap, you get your liquidation preference and you get the shares. That's the definition of participation, is you get both. Folks okay with this? So if A converts first while C is uncapped, they own 10 out of 55 million shares. What does that entitle to? It entitles them to that fraction of the value of the firm minus all the outstanding liquidation preference. Well, since A goes first, there is, 20 gets, Series B gets their 20 first because they haven't converted. But notice C also gets their 50 first because they haven't hit their cap. So they get their 50 first and they get another 5 million shares. See what I'm saying? This is nuanced. This is one where we're starting with a bang. There's, you understand this really well, the rest of it is easy peasy. So this is the one where I would recommend people listen to my video over and over again until they understand what I just said here. And that needs to be greater than what? 10. Because if you don't convert, you get your 10. Correct? So that translates, this is mathematically right. This is 10 over 10 over 55. So we multiply by 55 divided by 10. That just gives us 55. 55 plus 70 gives us 125, V greater or equal to 125. So what this tells us is if A converts first, and when they convert, C is uncapped, they're converting at an exit value of 125 million. So far, so good? Well, we now need to logically check that at a 125 exit value, that C has not hit their cap. Because if at this number they've already hit their cap, there's a logical inconsistency here. Do we agree? So I go and calculate what C gets at this point, assuming they haven't hit their cap. Well, they would get 50, which is the first 50 that they're entitled to, correct? And they would get 5 out of the 55 million shares as participation, correct? Times the 125 exit value minus the 70 that gets paid out as liquidation preference. You do the math here, this translates to 55 million, which is less than 150, which was the cap. Right? Remember, the cap was 150 because they invested 50 million, 5 million times 10, and they get a cap participation equal to 3 times their original in preference or investment. So 3 times 50 million is 150 million. So they don't hit their cap until they're getting 150 million total payoff. So here they've gotten 55 million, so we know they have not hit their cap. Are we correct? Are we okay with this?
Jiro?
Yes.
A quick question on that 150. Is that 150 on top of the initial $50 million they invested?
No, it's not on top. It's including the 50.
Okay, so it's $100 million return effectively.
That's right. That's right.
Okay.
I mean, you want to read the contract and see how it's written, but the way it's normally written, it's not on top, it's including the 50. Okay, but be careful because people can write things a bit differently. And you know, if you're dealing with the wrong person, they may try to do that, right? Like, oh, let me go change those 2 words in the contract and get more than the person signing thinks I'm getting. Like, that's a really shit move, but you know, there are some shitty people. I don't know if there are a lot of shitty people, but there are some shitty people in the world. By the way, and as I said, remember when we talked about participating preferred and how it seemed a little bit weird that the normal way to do it is just to add 1 sentence, right? I mean, that's consistent with some dickwads in the world, right? So, and that's the standard practice, right? So I like to read my contracts. So, folks, okay with that? Okay. Now let's consider case 2, which is the case where A converts first, but when they convert, C has already hit their cap. And let's see what the conversion would be there. Are folks okay with what I'm saying so far? Well, in that case, because C has already hit their cap, they don't get the 5 million shares anymore because they've hit their cap. Do we agree with that? So now A would own 10 out of 50. Yes or no? But how much liquidation preference would there be? There would be the 20, and now C has their cap. So they get 150. They get 150, they get 20 before A gets anything. So it would be V minus 170 times 1/5 needs to be greater or equal to 10. So multiply this by 5, that's 50, bring the 170 to the other side, that's 220. Folks okay with this? So they would convert at 220. By the way, now I know this is not what happens. Do we agree? Because 220 is lower than the 125 that we did earlier. Are we in agreement? So we know that this is not correct. Look, just for completeness, you don't even need to calculate this because you know this isn't the right answer because this one is lower. right? But we can check at 220, has C actually hit their cap? It's the 50 plus 5 over 55 times 220 minus 70. Turns out you do the math, that's way, way smaller than 150. So we know that this is not even a logically consistent possibility. It's not internally consistent. Are we okay with this? So, this one is a, whatever, tossed in the junk, but you had to check it. Are we okay so far? So now let's go check, well, what if B goes first? If B goes first, then they get 5. If C is still uncapped, then C gets their 5, B gets their 5, and founders get their 40. That entitles them to that fraction of what? V minus the 10 that goes to A because A is not converted, and the 50 that goes to C because they get the preference and the participation. That has to be greater or equal to 20, which is the 20 that B is entitled to. You do the math, you get 260. By the way, 260 is not the right answer, right? Because remember, B had mandatory conversion at 200, right? So we know in this scenario here, B would actually need to convert at 200 million because of mandatory conversion. Are we okay with that? Is this what happens first? No, right? Because 125 is less than that. So we know that this is also not the right answer. Are we okay so far? Now we check the fourth scenario. What if B goes first, and when B goes first, C is actually capped? Look, we can go through the motions and calculate it, but logically we know it's not even possible because, look, here's another thing. We could have skipped some of these calculations because our first V was 125. When the company's worth 125, it is impossible for C to have hit their cap because their cap is 150. There's no way to give them 150 when the company's worth 125. See what I'm saying? So I'm doing the math here, but actually case 4 and case 3, case 4 and case 2, we didn't actually even need to calculate them once we saw that this was less than 150. See what I'm saying? So sometimes it's good to have intuition and judgment to know I can skip this calculation. It can save you time. Are we okay with that? But anyway, just for completeness, I have the calculations here in case you don't spot those things. 5 over 45 of V minus 10 minus 150, greater or equal to 20. That gives us 340. Again, mandatory conversion at 200, but 200 is bigger than 125. Are we okay with this? By the way, are folks okay with me saying it's obvious that C does not hit their cap or convert first because 125 is less than 150? So the fifth scenario, I also don't need to check it. Okay? Well, then we have already now determined what? We have determined that A converts first. They convert at an exit value of 125. And when they convert, we know that C has not hit their cap yet. We know all of those things. So far, so good? Now let's go figure out who converts second. Well, it's either B or it's C. And if it's, B that converts first, we also know that it could either be that C is uncapped or that C is capped, correct? So let's take a look at the conversion decision, assuming that C is uncapped for B. Well, B gets 5 million shares. When they convert, how many shares total would there be? 40 million to founders, 10 million to A because A is already converted. 5 million to Series B and 5 million in participation to Series C because C is still uncapped. So they would own 5 out of 60 million shares, correct? And how much preference would there be left? There would be left just the 50 to Series C because A and B have converted now, correct? And that has to be greater or equal to 20. That gives us 290. We okay with this? By the way, 290 is above 200, so we actually know they're pulled into mandatory conversion. So they're converting at 200. Are we okay with this? Then we can check, is C indeed uncapped? The answer is yes. You do the math. It's done in this vertical. I'm sorry that you have to flip your computer around a bit to see it the right way. Don't drop it because it could break. It's not my fault if it does. But you do the math. It's clear. It's uncapped. Folks okay with that? Now we can look at case 2. Well, if instead C is capped, then now there's no shares to C because they hit their cap, but they have their 150, correct? So you do that case here, you get 370. Again, that means 200 million. Now you do a check, you're going to see that actually this case is internally inconsistent because when you look at V370 or at V200, it doesn't matter. You do it either way, it's going to give you the same answer. C is actually still uncapped here. Are we okay with that? So what have we learned? Well, we need to check one more thing. Does C actually convert first? Well, look, since we know that when B converts, C has not hit their cap, since they haven't hit their cap, there's no way they would convert. Because unambiguously, converting when you haven't hit your cap hurts you. Because not converting gives you the benefit of both. It gives you liquidation preference and it gives you the share. So we know for a fact that Series C is not going second. You could do the math to validate the statement I made, but once you do the math, you'll see like, oh yeah, it was a no-brainer. Are we okay with this? So what have we established? We have established that Series B is going to convert at 200 million. And it's actually not because they want to convert, it's because of mandatory conversion. Are we okay with that? What does that mean? We know when you are forced to convert when you don't want to convert, what happens to your payoff diagram? It's got to jump down, right? Because it sucks to be forced to do something you don't want to do. So we're going to have to calculate jumps and drops in our payoff diagram because of mandatory conversion. Folks okay with that? Now, that's going to introduce some additional complexity in our last step, by the way. But before we get to the last step, we want to find out, well, hey, guess what? Now we're left to just Series C, correct? So we need to find two things out with Series C. First thing we need to find out is when do they actually hit their cap? And then once they hit their cap, we then want to find out, well, when do they choose to convert? So we're actually going to find out two things now. When does C hit their cap? They hit their cap when their participation gives them an extra 100 on top of their liquidation preference, correct? So when this, which is their payoff from being uncapped, is equal to 150, they have hit their cap, right? Because they get this percentage of this until they hit their cap. So you do the math here. That means they hit their cap at an exit value of $1.25 billion. And once they hit their cap, they start asking, do we want to convert into common equity? Because we've plateaued to our 150. So when will they convert? They know when they convert, they're going to own 5 million common shares, which will be out of a total base at that point of 60 million. So 5 over 60 million, 5 million over 60 million of the whole value with no more liquidation preference, because when they convert, all the liquidation preference is gone. That has to be bigger than their capped preference. In other words, they convert to common equity at an exit value of $1.8 billion. Folks okay with this? now we get to maybe the most nuanced part of this problem, which is here's the thing, like, it actually, if you take a step back and familiarize yourself with a waterfall analysis, you'll see that everything I'm telling you here, it might sound complicated the first time you're seeing it, but it's actually all logical. So let me put it a different way. No one ever taught me how to do a waterfall analysis. I just figured it out. It's a logical exercise, right? And the thing is, I can't teach you every waterfall analysis in the world, because every complicated capital structure is subtly different. And so it's actually more valuable to learn to think through the process than it is to memorize the process on a case-by-case basis. Literally memorizing process on case-by-case basis and treating every single example I do as its own little bubble is nuts, because then you'll never figure it out. Like, this is a reason through it type of exercise, right? So hopefully from listening to this example and reading some of the other examples that we do in the handwritten documents, right? And by looking at the first example we did off of the slides, and by working through some examples from the practice final, it's by practice like that you start to train your mind to think through it, to kind of, do that interplay between logic and the math, right? Because literally there's an infinite number of possibilities with these waterfall analysis things, right? You can't cover them all. But the tricky thing here, the one that's easiest to miss, is that because of mandatory conversion, you know that you need to calculate jumps and drops in the payoff diagrams. And so what I do on page 10 here is I actually calculate the jumps and drops for all the stakeholders, because every stakeholder is going to have jumps or drops. Series B, they're being forced to mandatory convert, so they're going to get a drop. Their loss is everyone else's gain. And so we're going to figure out the gains of everyone else as well. Okay? I'm just going to do the calculation for the drop for the investor B. The calculations for investor A, investor C, and for the founder, those calculations are listed on the document. You can review those calculations. And if you have questions, you can ask me. All right? But I think once you see one calculation, you kind of get the gist for the other ones. Go ahead. Mike, do you have a question? No? Okay. So can I just talk through the investor B action? Yes? So let's think about, the question is, what happens to investor B at 200 million? Well, just below 200 million, they were getting their whole liquidation preference, correct? So just below 200 million, they get 20 million. The moment they hit 200 million, so just above, or let's call it at 200 million, what do they get? Now they get shares because they're forced to convert, correct? They get 5 million of the 60 million of the 200 million minus the 50, because here C is still uncapped. So C gets the first 50, and out of the remaining 150, 200 minus 50, they get 5 out of 60. Make sense? So they actually get 12.5 million. So this tells you how much it sucks for them. They all of a sudden go from getting 20 million to getting 12.5 million. This has made them lose 7.5 million bucks. And that's not small potatoes. I mean, maybe if you're Jeff Bezos, it's small potatoes. But if you're like normal human being, this is even scarier than what I'm thinking about with my house right now. $7.5 million drop. That 7.5 million is literally going to be divvied up between the 3 other parties. And we need to figure out exactly how it gets divvied up. Sound okay? I'm not going to go and talk through the calculations for the others, but you can look at it. It's actually valuable to try to reason through it. And again, if you can't reason through it, you can shoot me an email and I'll do one of two things, which is if I don't get too many emails, I'm going to respond to them individually. If I get a flood of emails, I'll just say, everyone, we're going to do an impromptu 30-minute Zoom session where I talk through it. Sound good? But what we find out at the end, drop of 7.5 million for investor B, a jump of 1.36 million for investor A, a jump of 0.68 million for investor C, and a jump of 5.45 million for the founders. You add those things up together, the jumps are exactly equal to the drop. Because guess what? It's net zero, right? The company is still worth 200 million. It's just being divvied up in an alternative way now because of the forced conversion. Are we okay with that? All right. Well, now given this, we can now put a bow on the on this wonderful gift called waterfall analysis and figure out our payoff diagrams. Okay. Let's look at Series A. Series A, they get nothing from 0 to 50 because Series C has the senior liquidation preference. Do we agree with that? Yes or no? Then from 50 to 80, they get 1/3 because they're equal preference with Series B. They have 10 million, Series B has 20 million, so they have 1/3 of it. So far, so good? Then we know from 80 to 125, they're plateaued at 10. Why? Because they weren't converting yet. They start to convert at 125. Make sense? What happens once we hit 125? They choose to convert. When they convert, they have 10 out of 55 million shares because they get their 10 million shares, founders get their 40 million, and Series C participates 5 million. Do we agree? Then what happens at 200 million? At 200 million, they get a jump of 1.36 million. That's their windfall from Series B being forced to convert. Do we agree? But once Series B is forced to convert, there's no longer just 55 million shares in the company. There's 60 million because they've got their 5 million. So the slope thereafter is now 10 over 60. Does that make sense? Then what happens at $1.25 billion? C hits their cap. Because C hits their cap, 5 million shares disappear. Do we agree? So the slope now goes from 10 out of 60 to 10 out of 55. Do we agree? And then what happens at 1.8 billion? We go back to 60 million shares because C chooses to convert. And we're back down to slope of 10 out of 60 forever. And this is our payoff diagram. That is what I call an ugly payoff diagram. That ain't pretty, right? But it is what it is. That is the payoff diagram. And I've walked you through the process. Let's do one more. Let's talk through Series B. Poor Series B. They get nothing for the 50. They get 2/3 up to 80. They plateau until 125. Usually when we say plateau, it sounds like a bad thing. It sounds like a good thing at 200 when they're forced to convert and they lose 7.5 million. But you know what? At least they have a slope now of 5 out of 60 because they've got their 5 million shares. And 5 out of 60 becomes 5 out of 55 at 1.25 billion because C hits their cap. And then it goes back to 5 out of 60 at 1.8 billion because C chooses to convert. That is the story of the payoff diagram for B. The other two payoff diagrams, Series C and founders, we can tell the same story. You know what? I'll do the founder story, right? And I'll leave it to you guys to verbalize and take the logic through the Series C payoff. And again, just like I said with the jumps, if you can't figure it out, you can ask me, okay? So let's talk about founders. Founders get nothing until 80. because there's 80 million total in liquidation preference. But then the moment 80 is reached, they have 40 million shares that are worth something. But the thing is, they don't get 100% because there's still the 5 million participation for Series C. So they get 40 over 45. And then at 125, their slope goes down because now A gets their 10 million shares. So it goes down to 40 over 55. And then at 200 million, they're like, oh yeah, baby, I just got $5.45 million from Series B because those suckers are forced to convert. So they get a jump of 5.45 million, but their slope again goes down a little bit because now those Series B have some shares. So 40 out of 60. Then again, C hits their cap at 1.25 billion. So the slope goes up to 40 over 55. And then at 1.8 billion, again, same story. It goes down a little bit again because Series C now converts. Okay, so that's this. By the way, you will notice I did not do a very good job drawing this to scale because 0 to 50 was this much, 200 to 1.25 billion is this much. Doesn't seem to, it's not log scale. I don't know what scale. This is Jiro scale. Okay, Jiro scale is weird. When you do the final exam, you do not need to worry about drawing it to scale. If you draw it in this weird distorted topology like this, it's okay for the final. Okay, so it's because I think all of us can agree, even though this is not drawn to scale, you look at this drawing and you understand what's happening, correct? That's all that matters. What I want you to do is I want you to tell me when there's a jump, you tell me how big the jump was. And I want you to label the slopes very carefully. And I want you to delineate the precise breakpoints. That's what actually matters. Sound good? So that is our final waterfall analysis example for this class. And, you know, again, waterfall analysis is something that is best learned with practice. So I almost encourage you to solve this problem that we just did in video. Turn off the video and try to redo it. It's actually worth the effort because this is an example that I chose for like ultra forcing you to learn because it's kind of heavy on complexity. Then after you do that, do some of the extra exercises that I give. In particular, do some of the practice final problems and do the problems that are in this waterfall analysis example, which is the 9-page document. Again, this is just if you want to have maximal practice, this is my guidance. Because as you get practice, that is the way that you get comfortable to do this in the real world. Sound good? All right. So this wraps up our formal discussion of waterfall analysis. What we will be doing next week is we're going to talk about how we value these complex securities using option pricing techniques. If you are like, I'm not sure where that's going, totally normal. I'm going to give you guys a very bare bones treatment of options, super bare bones. I'm just giving you the bare minimum to be able to do it. And then we're going to do it. And if you are worried because that sounds super complicated, it turns out it's not quite as complicated as it sounds, or at least the way I'm going to teach it to you. Okay? So that's what we're doing next week. That is what we're doing, I guess, in the last 2 lectures of the course. Okay? All right. I hope you guys have a nice evening, a nice remainder of the week. And yeah, see you guys later.